What's up, homies? It's Arizona Javi, and you're watching this video because you started researching buying a house in Phoenix, Arizona, and you came across this term FHA. Like, what is this FHA thing? My BBL realtor keeps telling me that it's the best loan for me, but I want to figure out exactly how it works and why it's the best option for me. So we're going to go over all the pros and cons, how it works, and you're just going to have such a very deep understanding of what it is. And you're probably going to know much more than most realtors out right now in the wild. So get ready, get your paper, get your pencil out. We're going to take a lot of notes today. We're going to learn a lot today. For starters, let's do a very quick history lesson. It's 1934. It's during the Great Depression, and nobody wants to freaking buy a house. Getting a home was tough. Banks typically demanded a really large down payment and very quick repayment terms. In an effort to revitalize the struggling housing market, the National Housing Act was proposed, and in this act, the Federal Housing Administration, or FHA, was created. FHA's main goal was to make homeownership more accessible. They did this by basically insuring mortgages for lenders. This insurance reduced the risk for banks, encouraged them to offer loans with smaller down payments and longer repayment terms. Essentially, FHA opened the door to home ownership for many Americans, including those with limited savings and less than perfect credit. So all in all, you need to ask yourself whenever you're thinking or talking about FHA, does it align with its two goals? One is to lower the barrier of entry for home ownership, and two, make it safer and more comfortable for the investors that are buying these mortgages to feel basically safer. So what is that low barrier of entry? Well, this basically applies to most states. So let's just kind of go over a general idea of what that means. Your credit score only needs to be around the 580 to 600 range. Every lender is different. Some lenders are a little bit more conservative and want you to be in the low 600s. Others are okay going to 580. What I've known usually is once it goes below 580, then they want more than your average down payment. So it really doesn't make sense to me for you to be under 580. You only need 2 years of employment. You only need 3.5% down. That means you get your purchase price, you multiply by 0.035, and you get your down payment amount, which on average, you know, here in the Phoenix, Arizona area, we're looking at starter homes of between 300 to 500. It's going to be about 12 to 15K ish around there. And the best part of it all is the interest rate will be lower. Great website for you to consider is mortgagenewsdaily.com. It's completely free. They're not sponsored, but here you can get a good idea of how the rates look like for FHA. You're going to see historically, they've always been a lot lower than conventional. This one that says 30-year fix is the conventional rate, and this one right here is the FHA one. So why is the interest rate so much cheaper? Well, it's a safer investment for basically investors. Government insures it, so it's nice and protected. But on top of that, there's something that really just makes it a lot safer for potential investors. Because remember the second goal, right? Make it more accessible, but also make it more safer for investors. And that is something called mortgage insurance, which is probably one of the biggest cons with FHA. Mortgage insurance is a payment that gets added on your mortgage payment. That essentially what happens is if you ever default on your mortgage, whoever is the owner of your mortgage, the investor, is protected. That insurance kicks in and they get the majority of their money back, and they're rest assured that their hard-earned investment in your mortgage will be somewhat protected. Okay, if you're getting any kind of mortgage and you're paying less than 20%, you're going to have to pay some sort of mortgage insurance. But with FHA, you actually pay that mortgage insurance twice. Now, I'm going to be using different forms. PMI is what's used when you're talking about conventional. Mortgage insurance premium is what's used when you're talking with FHA. At the end of the day, they're both mortgage insurance. I'm going to be using these phrases like interchangeably. So, just know that we're talking about mortgage insurance. I think the best way of showing you is just showing you on a calculator. So let's say we're buying a $400,000 house. We're doing 3.5% down. Let's say the interest rate right now was a 6.33. The interest rate 6.3. So your monthly payment will include the principal and the interest, your home insurance, a monthly. So you pay an annual premium, right? But they're going to divide it by 12 and you pay a 12th of that. Your annual taxes divided by 12. So let's say you're paying $2,400 a year. Well, that's only going to be $200 a month that you contribute. Here in Arizona, they're a lot lower than that. So we're going to go about $1,500. And honestly, you can probably get home insurance around $1,300. So we're going to reduce that too. Here's the thing. If you're buying a conventional loan, your mortgage insurance is based off your risk factor. That way, to protect investors, if it's a riskier loan, they're going to have the buyer pay a higher monthly premium to protect the investors. Think about the poor investors, right? So here's a nice little cheat sheet, right? So if you have a extremely good credit and really high down payment, you're going to be paying almost nothing for conventional. Whereas if you have like a horrible situation where you're barely putting anything down and you have really bad marks in your credit, conventional will charge you a lot. Well, with FHA, so you can see the range between 0.1 to 1%. With FHA, you're always going to be about 0.55. So it doesn't matter if you have amazing credit. If you're the goodest boy and girl in the land, they're going to automatically just deem you a little more risky than everyone else. So in this case, you're going to be paying $176 per month. So in this example, that $176 would stay with your payment forever until you sell the house, you refinance it, or you pay it off completely. You're never going to get rid of it. There's one specific weird example where if you put 10% down more when you're closing on the house, after 11 years, then you'll be able to get rid of it. But that's such a weird situation. If you're putting more than 10% down, you might as well go conventional, right? But for 99.99% of everyone else, that payment is permanent, and $176 will hurt. What hurts more is that if you would have gone conventional, whatever PMI you would have gotten, you're working towards getting rid of it, because once you've paid off 20% of your house, it goes away. For example, let's say you buy a $500,000 house, okay? You put 10% down originally, so your starting loan balance is $450, right? Well, as you pay off your loan, and let's say your house is still worth around the $500,000 range, once your loan balance is $400,000, then you can call your bank and get rid of your PMI. So it's kind of fun because you're actively working towards getting rid of it. Like you can make extra payments on your principal and do all kinds of fun stuff. With FHA, you're not doing that. You're not working towards that. And to make it worse, right, they just punched you in the gut and now they're going to go for a freaking uppercut. You pay 2 mortgage insurance premiums with FHA. There's the monthly one that we went over, but there's also a one-time mortgage insurance premium that you pay when you close on your house. Let me explain. In theory, if you're buying a house, let's say in this case, you're buying a $400,000 house, you're putting $14,000 down, your loan balance, your starting loan balance should be $386, right? Because you get your price of the house, you subtract your down payment, you get your loan amount. Well, you're going to see something really concerning with FHA, and that is when you're on your closing table, your loan balance is not going to be $386. It'll actually be $392. Why? Well, FHA is going to charge you a 1.75% premium on top of it, and they're not going to bill you right away. They're just going to add it on the loan balance. And you might think, well, that's not bad. Well, that affects all the numbers. Now, your principal and interest is higher. If you noticed here, your total interest paid actually goes up. So you end up paying for that additional 1.75 by a lot. And on top of that, your PMI also goes up. It's actually 2160. So it affects you in many ways. I know I just gave you a bunch of bad news. There's still some significant advantages here. For one, if you're in your glow up stage of your life, whether you were at the point where your credit was really bad and you're now recovering, or you're at the beginning stages of your journey, you can get into a homeownership situation sooner. You don't have to wait around the next 2-3 years for you to save up your 20% down or 5% down and get your credit up really high. You can get into a home sooner if it makes sense. For example, the first house I bought with my wife, we were like 19, 20 years old. Yes, prices were cheaper then, I'll give you that, but we saved up our income for a few months. We got into the house, we closed, and we lived in our home, which we were able to build equity and just have a place to call our own. We had some bad experience with landlords at that point, but because of FHA, we could start our life sooner as opposed to later. Now, we lived in that home for a few years, and eventually when it was time to move on to bigger and greener pastures, we were able to then sell and then go to the next one. And since then, we bought mostly with conventional financing, but still, FHA is a good, solid starting point. And on top of that, that interest rate is just still really tempting. So for example, let's say you're talking with a lender and you're negotiating back and forth. You followed your realtor's advice, which I always do with my clients, on how to talk to your lenders and how to make sure you get the best deal. Let's say you get like a 6.1 with your lender, right? Well, you then get the same lender to give you a quote for conventional, and for conventional, it's 6.7. Well, after watching this video, you might go, well, yeah, 6.1 is fine, but I got to pay all this PMI, yada, yada, boom, boom. I don't care. Look at the monthly payment for both. Another significant advantage is right now, either way, the interest rates suck, right? But with FHA, if you're able to, let's say, secure an extra few $1,000s from your seller, or you're working with a builder, you can use the extra money you get to buy the rate down, which you can do for conventional, sure. But with conventional, if let's say it's at 6.7, you use those extra few $1,000s to buy the rate down to 6.5, 6.4. That's like, meh, okay. But with FHA, because you're starting with a lower amount, and on top of that, your money goes a lot more because it's a government-backed product, so it's cheaper overall. You can use that extra money to get that 6.1 to like a 5.75 or like a 5.8. And now that's a much more significant impact. So don't just discount it right away. There's a lot of advantages and disadvantages, and it's worth considering both. If you are someone who's in a very good financial spot with great credit and good down payment, it's still worth your time to consider both and look at the numbers. If you're watching this Arizona channel, you probably are in the Arizona area and you probably don't have an agent. If you do have an agent, have them break it down. But for my clients, what I like to offer is an analysis, right, where we just go over each situation and see which loan is the better overall, projection of option for you based on your actual personal goals. All right, now let's talk about how it pertains to us Arizonans. Okay, so first and foremost, there's some loan limits here. If you're buying in Maricopa County, loan limit is up to $546,250 if you're buying a single family residence. Yes, there's some options for multifamily. We're not going to get into it in this video. So that's your loan limit. And for any other counties, it looks like Pinal and other ones, it looks like the loan limit is going to be about a standard limit, which is about $524,225. This is plenty of funds to get you a starter house. Right, if you're watching this house and you're looking to be in the 700 range, it's probably better for you to be conventional anyway, so like 600, 700 range with a larger down payment. But hey, if you're somebody that wants FHA, that's just the loan limit. Everything else would have to be made with a down payment. So if you were to want an FHA for a much more expensive house, you just would need a much bigger down payment, which in that case, it just makes sense to go conventional, but just have to offer it there. On top of that, Arizona does have some down payment assistance options. And essentially the way it works is it's still FHA. It's still backed by FHA. Essentially what we're doing is we're adding an Uncle Pepe in the mix, right? We're adding a third party in there that's going to be helping you with the down payment. But in return, Uncle Pepe needs something back. Why it's helpful is one thing I did not mention in all of this. Anytime you buy a house, you have to pay what's called closing costs. Closing costs is essentially all the fees that the lender's charging you, the title's charging you, your realtor, everyone is charging you for you to purchase this house. On average, with an FHA loan, they're going to be an additional 2 to maybe 2.5%. So in theory, if you're buying an FHA house, you're not just going to pay that 3.5% down. You're also going to have to pay closing costs, which is another 2.5%. The only reason why you don't really hear about this a lot is because most realtors and lenders will go, don't worry, we'll get the seller to pay for them, because you have to pay your own down payment, but the seller can contribute it gives you money to pay your closing costs. In theory though, they're giving you money that you could have saved off the price. For example, if there's a house for sale for $375,000 and you ask for $10,000 in closing cost, you got all your closing costs paid, and on top of that, you also probably you also probably have a little bit left over to buy the rate down. So overall, you're happy. But you could have also covered your own closing costs and paid your own closing costs and offered them $365,000. And the only difference is you would have had to come up with more out of your pocket, but you bought the house cheaper. $10,000 cheaper, maybe 40 to 50 bucks less on your monthly payment, maybe a little bit less on your down payment. But overall, you start off with a $10,000 jump start to get that paid off if you're looking to get paid off or over the life of the loan. But anyways, let's say you're in a situation where you get a seller that doesn't want to pay your closing costs. So it's going to be, let's say, use the same example. You're buying a $375,000 house. Your down payment is going to be 3.5% down. Your down payment is 3.5%, and there's going to be about 2% of closing costs. Well, if you're using a down payment assistance program, they can help you with maybe 2, 3, or 4%. Here I have a down payment assistance program pulled up that's commonly used here. It's called Home Plus. There's a lot of them. Don't think it's the only one. But here it says with FHA, there's different options. There's 2, 3, or 4%. Your credit score minimum is higher, and there is a higher fee that the lender charges you. There's also, max or borrower income and stuff like that. But if you look at the terms and condition, it is essentially a second mortgage. It's fully forgiven after 5 years. There's no interest, no payment, no deferred on the soft second mortgage. And of course, if you read the fine lines even more, the interest rates are set by the Arizona IDA and is slightly higher than the interest rate. So there is going to be a higher interest rate. So there's all these different factors, but it can be used to basically help you get that assistance. If you get the seller to pay your closing costs and you get, like, let's say you go for the 4% one where they're going to ding you for the highest amounts all across the board, but you could in theory create a situation where you're going to be zero down. So when you hear from these realtors and lenders, giving a zero down loan, it's using a situation like this, or maybe they're using a different type of loan where it's like 100% financing. So there's always a catch, right? Down payment assistance is there, it's available, but in my opinion, down payment assistance should be used so that way you can hold on to your funds. So that way you don't just buy a house and be left with zero in the bank. You use it. Yeah, your monthly payment's a little bit higher, but now that $15,000 you had saved for your house, you don't want to just be left with zero. So now you have that as savings and you buy your house, right? I'd rather you use it for that than, hey, Javi, I have no money in my bank account. I want to buy a house though. Great. Now you bought the house, but you still have no money in your bank account. You're setting yourself up for failure. Maybe that would have worked 10 years ago when houses were super cheap and things were going up. That's just not the best strategy for you anymore, at least in my opinion. And last but not least, if you're buying with FHA in Arizona, the house has to be in good shape, okay? You can't just be buying a house and just have it be in like a super fixer-upper with FHA. It needs to be structurally sound, okay? If the government's gonna back it, it needs to be something of stable condition. It needs to be technically move-in ready. And yes, whenever they send an appraiser out to verify the value, they will also verify that it is up to FHA code. But overall, that's the general gist of how FHA loans work here in the Arizona area. If you are in the process of buying a home relatively soon, within the next few months or next year, I would love to be the person that guides you through your journey, whether you're an FHA mortgage or a conventional mortgage. You can find all my information below. I can connect you with the best lenders if needed and make sure that you get taken care of. And of course, when we're ready to look for houses, I'll be the one personally guiding you on your journey. By the way, you might have heard from some people out there that they're getting a 4% interest rate, a 4.5, a 3.5, and all these weird things happening right now. If you want to know how people are getting that 4% rate right now in Phoenix, Arizona, go watch this video where I break down exactly how it works. And guess what? There are FHA loans that are getting that low. So watch that video, check it out, and I'll talk to you guys soon. Thank you.